Hello, everybody, and welcome back. Today, my guest is Dean Cashman. Dean is the head of equities at Eastspring Investments, and today we want to discuss recent developments in Japanese stock markets. Welcome, Dean.
Thank you.
Dean, Japan and the US strengthen their ties. On the other side, the relationship between Japan and China is really strained currently. Against this background, what are the prospects for the Japanese economy currently?
The Japanese economy has been surprisingly resilient, now in the context of a very difficult environment with a global pandemic. Now, that's mainly because of the progress that corporates have made, the much improved environment that we've seen through the restructuring, etc. But we're also starting to see the benefits of a global improvement, a gradual global improvement. Now, Japan does have to meet its commitments to the US and has, if anything, become closer. But really the relationship with China has actually improved a little over the last couple of years, and Japan is treading that fine line between meeting those US commitments, but also looking after its economic interests in China. But it's doing so prudently. We're seeing some, for example, some management of supply chains, some supply chains moving out of China, production in China being more addressed to the local market. I think overall, Japan is managing that environment fairly well. So whilst the geopolitical risk is something I think to be mindful of, but not just for Japan, I think for markets generally, but I think Japan is managing that situation quite well.
Hi there, just a 2-second break. Before we continue with the video, just make sure to subscribe to our channel now to not miss out any updates. Thank you very much and enjoy the video now. Japan has a new digital agenda. So what can we expect from this initiative, and in which areas will growth impulses emerge?
The digital agenda, that's something that's really being pushed by PM Suga. And I think it's something that COVID has highlighted areas where Japan lags. Some parts of the economy are very well digitalized. Others are clearly lagging. Government services are very much part of that, but also the paper-driven parts of corporate life as well, where you have to put your handcode, which is your personal seal, your personal stamp on documents. So there's the big drive to really improve that. And where are the beneficiaries? Overall, certainly it'll be consumers. It'll be consumers of government product. It will also be just the general improvement in productivity. Now, you may be surprised that Japan has actually, for the last several years, has seen a productivity growth ahead of basically all the G7 countries. Now, the broader benefit of this is greater likelihood that productivity improvement will continue. There will be beneficiaries from those companies that can implement these services. Now, for example, we have a company, Rico, that's really at the forefront of helping small companies digitalize their operations. They will certainly help, will certainly benefit. Overall, there'll be a lot of companies that implement these changes that will also benefit from cost and productivity savings. Where the investment opportunities really depends on how those individual beneficiaries are valued.
So the Japanese economy has its own challenges, especially demographics, but also years of recession and deflation. So what is the case for Japanese equity currently?
Japan clearly went through a very tough time. And I think most people still think of Japan as very much in those debt deflation years of the 90s and the earlier 2000s. Which was a long time. Therefore, it's that's what people think about. But it's really emerged from that over the last few years. And the reason it's emerged is it's the progress that companies have made in restructuring their businesses, and not just doing so as they did in the past when they're under pressure, but doing so more proactively, even when profits are improving. So what we see now is there's a clear improvement in margins. You can see, even with the recent hit from COVID, the recent impact from this exogenous economic shock, margins have fallen from a cyclical perspective, but they've only come back to the top of where they reached in the last cycle. So there's still a clear trend improvement. Now that, again, gives both resilience to the Japanese economy, but that improvement in corporate behavior continues, and that's likely to continue to drive not just maybe an unspectacular but solid economic performance to provide a lot of opportunities at the company level.
Corporate governance was previously considered a weak point of Japanese companies. So Shinzo Abe had taken up the issues. And so what has changed since then? And what's your view on that as a portfolio manager?
Shinzo Abe did certainly become a sponsor of that, a promoter of the improvement in governance. In my view, the real reason that's happening and the reason that it's likely to continue to improve is because there's a real economic imperative from both companies needing to be more globally competitive and from asset owners like the big Japanese pension funds who just need better returns from domestic risk assets, who are now becoming much more proactive in demanding improvements from companies. That's the context of why it improves. It's not perfect. But it's the direction of travel that's important, and I'm very confident it is improving. I've been having conversations with Japanese companies for many years about governance. For a long time, they were very one-sided. Now they're much more constructive. And given that we're longer-term investors, we're very aligned with having those ongoing discussions and really helping companies to understand where we think they need to improve, and that becomes part of an ability to help realize value. So that I think is very positive. I think it will continue. What we've really lacked to date in Japan, though, that final ability to really instill discipline in corporate Japan was what we call a market for corporate control. That is an ability to perhaps take over an underperforming company and kick out management. We're only just starting to see that develop. We've started to see not only increase what we call tender offers, more or less takeover bids, but historically, there was no such thing as an unfriendly takeover bid in Japan or an unsolicited takeover bid. That's starting to happen. That's really just in the last 12 to 18 months. That's very new. And whilst it's early days, that's a very important change. And again, this is part of improving performance and value realization.
Many Japanese companies have piled up a lot of cash. So what are they doing with those cash? What is the perspective for investing it? Other than just buying back shares?
Well, the buying back shares and the improving dividends are important because it's realizing ultimately who are the owners of companies and that you need to earn a competitive rate of return. So that in itself is important. We've seen dividends, for example, in Japan be much more resilient than other markets through the COVID shock. And I think that is testament to the fact that there is a lot of cash. Balance sheets have improved because cash flow has been very good. Earnings have been very good. What do they do beyond that? Well, I think we've also starting to see an increase in strategic investment. For example, we've just had in the last couple of weeks, had the Tankan out, which is a government BOJ survey of companies and their intentions. And we've seen the expectations for capital spending from companies this year for the March survey, which is usually the beginning of the fiscal year for Japan, usually very conservative. It's actually the highest expectation of CapEx since 1990. And that's when we're still facing COVID uncertainty. I think that shows you that strategic investment is picking up. The companies see opportunities and they see those growth opportunities. And I think that shows that the cash can be productively used, as well as the fact that capital efficiency will improve with the share buybacks, etc.
So 2020 was definitely a growth year. So what is the case for a value strategy to get exposure to the Japanese equity market now?
I think that there's been a very clear thematic preference in markets, not only Japan, but globally. And that preference is to really pay any price for growth. The belief is you can't pay too much for growth. Now, in our view, that's always a mistaken assumption. Now, value is not about just buying a company on cheap PE or cheap book. Value is a return-based concept. It's about what the income stream a company can produce is worth today. A theme might be fine, but if that theme is vastly overvalued, that's not a good investment. On the other hand, there are a lot of companies, and we certainly see this in Japan, there are a lot of companies with good income streams that are out of favor and that are very mispriced on the other way. So they're very cheap and they're very good opportunities and they are good quality income streams. That's where the opportunity is. Now, if we look at the dispersion of valuation, so we can look at the way style is valued, so what the market's paying for growth companies compared to value companies. And you can see that we're at a generational extreme. The market's the spread of or the dispersion of valuation has never been this extreme. We're in Japan, certainly it's way beyond where it was in the dot-com bubble. That all those neglected income streams, particularly in an environment where company performance, company earnings, just business performance is actually surprising in its resilience, and it's being quite positive in terms of both the near-term outcomes and projections. Now that says there's ample opportunity. There's a lot of neglected companies that look like very good investments because they're materially mispriced.
Where do you currently find interesting investment opportunities in Japan?
No, we're very much bottom up. We look company by company. We don't start with a thematic view or a macro view. We look for those best opportunities from the company level. And we're seeing quite a number of those. Now, that group of very narrow momentum stocks that's been driving markets and look quite expensive and, in our view, dangerous. On the other hand, now there's an increasing group of companies that look very interesting. And so the opportunities are varied. So it might be something like Seven & i, which is the large convenience store operator, not only the largest in Japan, but it's basically now the largest convenience store operator in the US. Very well-run company, fallen out of favor for various reasons, and now that's very attractively valued at a point where the potential returns on that business look quite good. It might be something like Honda. The auto companies have been out of favor, but it's actually it's the dominant motorcycle producer globally, very high margin business. It's quite well positioned in technology for the technology transition, and they've been very proactive in restructuring their business to improve profitability. So even through this period, they've actually been a very strong cash generator. Or something like Takeda, a pharmaceutical company where the market was, in our view, overly concerned around an acquisition they made, a company called Shire. Now it has a strong pipeline, again, very good cash generator. They've actually managed the acquisition much better than the market was giving them credit for, but it's extremely cheap. So, there are varied opportunities. There are certainly plenty of good companies that we can find that we think provide a lot of upside.
So this was Dean Cashman, Head of Japanese Equities at Eastspring Investments. Thank you very much, Dean, for being with us today and sharing your insights.
Thank you, Thomas. It's a pleasure.